Boston Omaha is a company that I think has gotten beaten up over the last couple of years for unfair reasons. Over the last 3 years, we've seen the company fall about 50% in terms of their share price. Despite this, the company continues to grow quite quickly. And one thing that you have to know before we get into all of the discussion about Boston Omaha is that this company is broadly divided into a lot of different parts. A very large portion is Link Media Outdoor. This is outdoor advertising. This is literally billboards. The company goes out and buys billboards, and then they service those billboards, and then they collect very high margin revenue from those billboards. As of their most recent earnings report, they pulled in about $11.8 million from these billboards. The gross margin is about 70%. So they make a lot of money. There's a lot of net income that's coming off of these billboards. Now, obviously, this particular business segment isn't growing tremendously quickly, especially right now because we've seen kind of a crunch in advertising dollars. But historically, Link Media Outdoor has been one of the fastest growing sectors of the company in sort of lower rate environments when you're seeing more economic activity. But as of right now, Link Media is kind of struggling a little bit. The big growth engine for the company recently has been Boston Omaha Broadband. The company has made several acquisitions over the last couple of years, including Airbeam and InfoWest. Basically, they are just going out and they're buying all of these broadband providers. This is also incredibly high margin revenue. The growth in the most recent earnings report, again, only 2.3%. There's been a bit of a struggle, but the gross margin is 80% on this entire business segment. And so they're pulling in a lot of money from this business segment. The more individual divisions are growing incredibly quickly. Recently, the really big growth engine for the company has been General Indemnity Group. This is literally short insurance. They've written a lot of premiums. Again, another fairly high margin business with almost 50% gross margins across the board. This is really solid. Link Media, approximately 4%. Free cash flow, double digits. And Boston Omaha grew by about 50%. A lot of that is acquisition based, of course. And then General Indemnity Group grew high double digits, 40%, 54% on the EBITDA. Their Boston Omaha asset management is growing tremendously. The three major business segments, the billboards, the broadband, and the insurance, are all incredibly high margin businesses. And so all of that money that comes in from those high margin businesses is fueling what I would say is the main growth engine for the future, which is their investments. And so fundamentally, Boston Omaha is an investing vehicle. The main thing about this company is basically that they're Berkshire Hathaway too, right? And so they're going out and they're making good investments, and those investments are what is fundamentally powering a lot of the growth of the company in the future. They've gone out and bought everything from banks to, they've Build for Rent, which is their real estate division. The actual value of the fund is $4 million, but the proceeds, they've brought in $11 million in proceeds from Build for Rent just in the last year and a half. They've gone out, they've bought banks, they've bought more insurance companies. They have two really big investments, Sky Harbor and Dreamfinders Homes. They're also buying back shares, which is incredibly good to see. There's been a lot of concern with this company that things might actually be slowing down. They have decided that they're going to use some of their cash to start buying back shares of the company, which is good to see. More broadly, one of the really big things that they have been able to do is that they combine a lot of their businesses together, where every single individual part sort of feeds into everything else, which is working tremendously well. Their broadband division is partnering with another company that they're invested in called Dreamfinders Homes. Dreamfinders Homes goes out and they build communities for homes, which they do tremendously well. They're very capital light. They have had tremendous success, not only in the places that they've been investing in, but also they're not building spec homes. They're building homes that have actually already been purchased in communities that are growing very quickly. And so fundamentally, they're doing very well. Dreamfinders Homes has partnered with the broadband division of Boston Omaha, and they've created fiber fast homes so that every new home that Dreamfinders Homes builds, they automatically come with a fiber connection from Fiber Fast, which is Boston Omaha. And so Boston Omaha is winning on both ends here. First of all, they have the growing broadband business segment, which is feeding into a partnership with another company that they actually own a piece of, which is Dreamfinders Homes. And so it's this incredible sort of meshing together of all of their sort of nauseant businesses that they own, which is why I think Boston Omaha is such a compelling investment moving forward. Boston Omaha has been a company that I've been invested in over the last couple of years, and I think that they continue to do fairly well. There was a bit of drama. One of the reasons why I thought this was such a good company is because there are co-CEOs to this company, and typically companies that are run by two CEOs tend to perform a bit better than companies that are run by one CEO, so long as there's a unified vision for what the company should look for, and at the time there was. The two CEOs that were running this were Alex Rozek and Adam Peterson. Alex Rozek had a lot of clout because he was the nephew of Warren Buffett, and so he got a lot of clout initially because people were like, oh, Warren Buffett's like the greatest investor ever, and his great nephew is now running a company, and it's doing sort of basically the exact same thing that Berkshire Hathaway is doing, which is investing fundamentally in their businesses. And so there was a lot of clout that surrounded the company, and I think that the stock price was hyped ticked up quite a bit because of the appearance that Alex Rozek would be sort of the incredible investor, Warren Buffett style. Alex Rozek did leave the company, and as a result, the company has slid quite a lot in terms of stock price. This has also combined with the fact that the advertising revenues are not growing as quickly as they were, partially because of the decline in just the general economy. The company has suffered a lot of weakness recently. The company is cash flow positive, which at the time that I started investing, they were not. They have been able to reduce their expenses, and their revenue has grown to the point where they are profitable consistently. Their current assets, they have about $37 million in cash and sort of a bunch of other, U.S. treasuries and sort of short-term investments in marketable securities for a total of $126 million. In total, their total assets are $721 million. The vast majority of their assets are tied up in their investments. So this is like their Dreamfinders home stake. This is their Sky Harbor stake, all sorts of everything. If you take a look at their actual liabilities, their current liabilities is only $61 million. Accounts payable is about $21 million. And so there isn't like a ton of actual debt here. The total amount of liabilities is $173 million. Lease liabilities is $55 million. And then long-term debt is about $43 million. And so they can very easily service this debt. Their cash pile of $37 million is easily enough to service this $43 million in debt. They are also beginning to be consistently profitable. If you sort of look at the net income statement of this company, you sort of get a different statement, but that is because a lot of their investments are in publicly traded companies. So for instance, Dreamfinders Homes is a publicly traded company and they fluctuate quite a bit. They're a very volatile company. They're a sub $2 billion market cap company, as well as Sky Harbor Group. This is also a publicly traded company. This fluctuates dramatically. This also used to be a SPAC. This is an actual microcap company. Their stakes in these companies, because they are publicly traded, they get rated literally every day. And so the actual net income of the company swings wildly based off of the proposed value of their investments. Berkshire Hathaway, for instance, you don't know how much Geico is worth. The fair value of Geico isn't changing 40% a year. It's not going to affect Berkshire Hathaway's balance sheet all that much, as opposed to Berkshire Hathaway's balance sheet swings wildly if Apple goes up 30% a year. There are similarities in these two companies. I think overall, there's a lot to like here. One of the big things about investing in Boston Omaha, they're a microcap company. They're worth less than $500 million. Granted, they have, an excess of $550 million on their balance sheet. This company is incredibly volatile, and you are basically betting on one guy's investing decisions, which is Peterson, the guy that runs the company. You're betting that Boston Omaha, they will continue to make good investing decisions, and that those investing decisions will continue to grow over the long term. There's a lot of risk with this company. I think there's a lot of reward, so long as they can continue to execute in the way that they have. Since 2011, they've had a very good track record of investing, not only in basically every business segment that they have, from advertising to billboard to broadband to the insurance businesses that they have, to just even in general Sky Harbor and Fiberfast Homes and Dreamfinders Homes. I think Boston Omaha is an incredibly interesting company to look into. And hey, if you enjoyed this video, we talked about this live. Come hang out. Also subscribe and like the video.